So I think let's start. We are on time. Good afternoon, everyone, and very warm welcome to our webinar. Uh, as everybody is aware, there has been a lot of movement from a corporate tax perspective. Since the law has been introduced, there has been a lot of cabinet decisions, ministerial decisions, and FTA clarifications which have been issued. And it is just keeping all of us on our toes and excited at the same time. The effective date or corporate tax is just less than a week away to go live. And there is still a lot of communication which is still to be expected to come in the meantime. So the purpose of today's webinar is just to go through what has happened so far, just talk about some of the FTA and ministerial and cabinet decisions, just decode some of those, some of the important key elements so that you guys are aware what needs to happen and what's going on so far. Then also we're going to talk about the ministerial, the explanation which has been given by also the ministry. And then we're going to talk about what needs to happen from a readiness perspective, what businesses have to do, things like that. So that's predominantly what's going to be our agenda. In terms of speakers, so we have my colleagues, Suhail and Yedu, who are going to be assisting me in the webinar today. So just as an introduction, my name is Arslan Mushtaq. I am the partner tax at athGADLANG. We are a firm based across various countries within GCC and helping our clients in various tax compliances across GCC region. So just an overview on the agenda, what's going to happen. So like I said, so I think we're going to be decoding some of the decisions which have been issued. Then we're going to be talking about the explanatory guide, which has been issued by FTA, and some of the important aspects from there. Then some of the administrative stuff to do with the registration, filing, etc., things like that. And then we're going to talk about the roadmap, and then we're going to do a Q&A session at the end. So the idea is our presentation part is probably going to be around 40-45 minutes. And then we'll have time for Q&A, and then we'll take questions from the audience. So just as ground rules, so we're going to try to make this webinar as interactive as possible. And please participate, ask as many questions as you can, and please post them in the Q&A tab, and we will pick them up either while we are going through the presentation, if it's relevant, hopefully, or we will pick them up at the end of the session. And please keep yourself mute. If you need to talk, then and then you will, if you're given a chance, then please come online, and then you can ask your question, etc. So that's that. So just as a starter, just take a step back and think about, okay, where we are right now, what has happened so far. So the decree law, which was published and issued back in December, so far there has been 17 decisions published in either ministerial, FTA, or cabinet decisions so far, and then many more to come. And explanatory guide, which also has been issued by FTA, and also also, the registration has been opened for the PGSEs and private companies. So now people can go and actually register their entities. 1st June 2023 supposedly is a go live date, although for the financial years starting from 1st of June. So we are almost there, and then UAE is going to become a tax jurisdiction and no more tax haven in less than a week's time. Pillar 2, so that's also something which is still under discussion. A lot has already happened on that front, but there is still the expected date of the applicability is still not set in stone yet, and is expected to be either 2024 or 2025. So time will tell. And then last but not the least is all the taxpayers will have 9 months after finishing the financial year before they have to do their first filing. So depending on what your financial year is, then people are going to start filing their returns at some point in 2025, early 2025. So this is where we are. So now I'm going to dive into some of these decisions which already have been issued by different bodies, and then we're just going to break them down for you. So in terms of Cabinet Decision 116, so it sort of explains that there are 2 tax rates which are predominantly going to be applicable in the country. For income up to 375,000 is going to be 0%, and then anything above 375,000, that's going to be 9% applicability. Then another significant decision which has been issued is to do with the small business relief. This is also very, very important given you think about the UAE as an economy as a whole. So majority of the businesses in this country are small and medium businesses. So this is a very good news for the small businesses, and the government has really thought through and also has tried their best to minimize the impact of the corporate tax and the compliance requirements on smaller businesses, and it doesn't become unnecessary burden on them. So what does that mean is any businesses whose revenue do not exceed 3 million in a given financial year, then they do not actually have to, they still have to file their return, but they do not need to actually pay any taxes. So that's a very good news. It does not matter how much profit do they make in that particular year, then it will not be subject to corporate tax. The only thing they will have to do, they will still have to file their return, although it's going to be a nil return, but the requirement from a compliance perspective is very, very minimal. However, there are certain exceptions to this ministerial decision. One is if anybody whose revenue exceed the threshold, then they will not be able to take the claim, the small business relief, because they will be outside that bracket. Then the second one is qualifying free zone, and also the companies which are part of the MNCs which are subject to the Pillar 2 reporting. So those are also not going to be coming into this ministerial decision. There is one thing which is very, very important and which has been clarified in the decision, that the relief is actually available for the tax period on or after on or before 31st of December 2026. So, however, if you look at the law itself, there is no restriction or the timelines which were put on in the law, but now in the cabinet decision, it has been the case. So it'll be interesting to see that what's going to happen. It really sounds like at the moment the relief is only available up until 2026 December, and after that the relief is not going to be available anymore. However, when you look at the law and also look at the explanation guide, then it doesn't seem to specify that there should be a timeline to it. So that's also something which will be interesting to see what's going to happen, and then I'm sure people will look at it and then see, okay, what they need to do. But good news is that there is a relief which is available, and the compliance requirements will be very less compared to any other businesses. So then you have another ministerial decision, which is clarifying that who is actually going to be exempted from corporate tax. So these are normal your government entities or government control entities, then businesses who are into natural resources, either in the extraction or non-extraction industries. So those will also be exempted. And then you also have a non-residents who have a state-sourced income, but they don't have P in the region. So they have also been exempted from the registration. Then you just need to make sure that that some of the other exempt persons say they will still have to register and without any exception. So for example, you have a qualifying investment funds, they will still need to register. And also you have the qualifying public benefit entities, they will still have to register and still have to file their returns as normal. So those people are still not exempted, and they will still have to take action. Then you have the timelines of the exemption as to by when people have to go and apply for these exemptions. So the first thing first is the other non-exemption people, for example, the qualifying public benefiting entities or the qualifying investment funds. They need to register themselves before the 1st of October 2023. Their registration process needs to be completed. And the timeline of the exemption is actually also very important. And it's also given so much flexibility for such businesses operating from the region. So what the decision explains that businesses will have 2 months or 60 days after they have finished their financial year, so that they can go back and assess what has happened in the financial year, whether the income they have had is still exempted, then they can go and apply for the exemption. Of course, they have to meet the certain conditions, but it's a good thing that they will still have 60 days after their financial year has finished to be able to apply for the exemption. Then there is another very, very important decision which has been issued by the FTA. It's about the being able to change the tax periods. Predominantly, what has been issued is pretty much in line with what happened internationally and what is allowed for the businesses in the tax jurisdictions elsewhere in the world. So according to the decision, what they have said, if, for example, you are in the process of liquidating an entity and you have to go and apply for a shorter period or a longer period just to get the benefit, then this is something you will be allowed to do. Also, if, for example, your financial year of the group or the reporting is different, then you can also request for financial year to be aligned with the group. Then there can be some other reasons. You could have a valid commercial reason or a legal reason where you think, okay, having a different tax period will benefit you. Then you can apply for a different tax period to be allowed. And although there are certain conditions which you need to make sure that you comply with, that the tax return is not yet filed for the requested period. And you will have the 6 months after the original tax period finished, then you can apply for this change in tax period. So what can you do is your tax period can be anything between 6 months to 18 months. And then that will, depending on the circumstances or what you really actually want to do. So you can have a shorter period or you can have a longer period of tax return to be submitted. So anything outside of that period, it's not going to be allowed. So for example, anything less than 6 months, you will not be allowed, or anything more than 18 months, then you will also not be allowed to do. Okay, in terms of the preparation and maintenance, so I know that there is a lot of questions around people not being sure, okay, whether they need to have their financial statements audited when it comes to doing the tax filing, or how is it? So this has also been clarified in one of the ministerial decisions, and there has been a limit put to the revenue. So if, for example, you are a taxable person and your income is, your revenue is more than 50 million, then it is mandatory for you to have audited financial statements. Also, it is mandatory for you, for a qualifying free zone person, to have audited financial statements mandatorily done. And then just I wanted to point out to you the fact they have used the word qualifying free zone person rather than a free zone person, because you could potentially be a free zone person, but may not be a qualifying free zone person or has a very little qualifying income. Then you will have to decide, and then you have to assess whether you need to have your audited financial statements or not, and whether you qualify towards the 50 million threshold. So that's also something people need to take into consideration and make sure they comply with that. Then there is another very important ministerial decision which has been issued for natural persons who are actually doing business activity in the region. So the threshold for them is a 1 million dirham turnover or revenue. So if their threshold, if they do not meet the threshold, then they do not need to actually be in the ambit of corporate tax. And if they are going to exceed the threshold, then the corporate tax is automatically going to be applicable to them. I know there is a lot of people who are confused in terms of whether there will be any taxes on their wages, on their personal income, which is earned through other means, or especially a lot of people have real estate investments, and what's going to happen to those. So the good news is that it has been clarified that if you even have a real estate income, for example, through the rent earning from the rental properties, then that is not going to be actually coming into the remit of corporate tax. And then your salaries and your personal income, other than these, will also not going to be in the ambit of corporate tax yet. So this is also very good news for people, and these guys will not be required to do any registration, or also will not be required to do any filing. So that's also very good news for people. So then there is another very important ministerial decision which has been issued to do with the transfer pricing and who actually needs to prepare the local file and master file, and what are the sort of general requirements. So the first thing you need to understand, okay, what is the threshold? Who actually must maintain the local file and master files if they have the businesses in the UAE. So the threshold for the transfer pricing local file and master file requirement is 200 million. Or you have the people who are going to be doing the part of the MNCs or having international businesses and having the head offices here, then they're going to fall under the Pillar 2 requirement, and then their threshold is already is almost like 3 billion. So that's already there. So those people will be required to maintain the local file and master files anyway. So typically, internationally and GCC wide, what normally happen that as part of the tax return, although there is no requirement for people who do not meet the threshold for them to maintain these files, but it is very important to note that we don't know what is going to be the disclosure requirement when it comes to doing the tax return filing. Internationally and GCC wide, for example, in Saudi and some of the other countries, all the taxpayers are still required to actually disclose to the authorities that what transactions you have had during the year, and also what is the method you have actually used in order for you to determine the arm's length principle. So although we don't know what the return is actually going to look like, so we don't really know whether there is going to be another different threshold which is going to be put in place for the people to either not disclose or disclose. And even if there is a disclosure requirement, then what exactly people will have to do. So whatever happens, generally the expectation is that there will be some requirement for people to at least do the disclosures. So it is important, even if people do not have necessarily requirements of the local and master files, then they will still have to maintain the documentation for the entities and for all your related party transactions. And even to the extent they will also need to see, okay, what are the criteria they are using and what needs to happen. So that's also very, very important for people to keep that. And then what we recommend that people maintain these records as and when it's happening is like a live data, because tax authorities, what we have seen based on our experience outside of the UAE, that the tax authorities can request any information at any point in time. And then you just need to make sure that you have the information readily available, and then so that you can actually report to the tax authority without getting into any trouble with them. Then other important thing which you need to then understand that, okay, in terms of the local file and the master file, whoever do need to maintain it, so what needs to be maintained within those files. So those really need to have, for example, the transactions on the local file. So if you are having a transaction with your non-resident person, so for example, you have any subsidiary or any related party which are outside the jurisdiction, then you will have to maintain those. And whatever method you have used on those arm's-length principle, then you have to maintain that file in the local file. Then you also need to have exempt persons within the jurisdiction. So it doesn't matter, for example, if you are dealing with the exempt persons as per the law, then you still have to maintain those documentations. If you are a resident person which are coming under the election, for example, your small business relief, even if you are falling under that category, you still have to maintain those transactions records. And also, if, for example, you are entities falling under different tax rates, for example, if you are a free zone entity, which potentially falling under the 0% rate, and then you are a mainland entity which is falling under the 9% rate, you still have to maintain those transactions under the local file. And then on the other hands, what are the exclusions? So for example, you have the resident persons who are coming under the same tax rates. For example, both of you are coming under the 9% rate, then you do not need to maintain. However, I would like to highlight in the frequently asked questions, before it was talking about that even if you are falling under the same rate, and then you were still required to be included. But given now it has been clarified in the decision, so now that's not the case. Then you have the natural persons who are independent. So then those are also need to be excluded. So for example, if you have a contract and then there is a third party involved who is acting independently, then, but the important thing is that you will need to make sure that you have appropriate documentation to prove the independence of those people. And then also, then you have the judicial persons in an unincorporated partnerships, but they need to be acting independently, and permanent establishments of non-residents who are in the same tax rate. So what you have seen is there is a word used being independent. So particular attention need to be paid to make sure that you have appropriate documentation in place, and where you know who are the people who are independent, and then you need to keep the appropriate documentation in order for you to comply. So I think that's all I had to say, and now I'm going to hand over to my colleague Suhail, who's going to talk us through what has happened in the explanatory guide. So over to you, Suhail.
Yeah, thank you very much, Arslan. So before I start my presentation, I would request all the participants to put your questions in a question and answer box, so that as soon as we complete our presentation, we can answer your questions and we can have a good discussion. So as before I start, I would take a quick view, because we need to get time for question and answers as well. So let's start first with the participation exemption. Now we need to understand what is participation. Participation means you are having 5% or more holding in some of the company, and the income earned from that, such as dividend and capital gains, they are exempt from corporate tax. Next point is entertainment expenditure. Now, as we already seen in the law as well, entertainment expenditure is deductible up to 50%. But as per the explanatory guide, first you need to understand what is entertainment expenditure. Entertainment expenditure can include meals, transportation, tickets, events, etc. But one clarification which is there in explanatory guide is entertainment expenditure done for the employees would be deductible 100%. So this is a very good clarification which was required, and it is there in explanatory guide. Then we go to interest. So if we talk about interest, yes, interest expense is allowable up to 30% of earning before interest, taxes, depreciation, and amortization. So that rule remains same, but what clarity is given is regarding interest recognition as per IFRS 16, that is lease. It may not fall within the ambit of interest, but one needs to take care and analyze it properly, because the intention of the law is to cover conventional lending, and lease is, it can be considered not a conventional lending. Loan from related parties, some of the transactions would be disallowable, interest expense would be disallowable, but if the intention is not to take a corporate tax advantage, it may be allowed, but we need to look at the rules of GAR as well as anti-abuse rule. Now let's understand about market value. In case of assets transferred to connected persons or related party, it has to be done at market value. If the asset transferred to connected persons are not at market value, then the difference amount of the market value and the amount of which you have transferred the assets, it would be added back to your taxable income, and then the calculation would be done. Now about deductible expenditure. In case of, for an example, you are doing a cash-based accounting, so expenditure would be deductible when it is paid and when you are maintaining the obligation to pay arises. Can you go to the next slide, please? So another important discussion which was there in explanatory guide is place of effective management. Now, this is a very important rule for all the companies. They have to take care, because if your place of effective management is in UAE, then your UAE income, business income, as well as the foreign jurisdiction income would be taxable over here. There is a difference between place of effective management and permanent establishment. What is place of effective management? Place of effective management is where your major managerial and commercial decisions are taken. So first we have to take care and determine place of effective management. If the place of effective management is not in UAE, then the things become different. But if the POEM concept applies over here, then global income of the foreign juridical persons will be taxed in UAE. Can we go to the next slide, please? There's a difference between place of effective management and permanent establishment, as I said. So you need to understand when the day-to-day work from where it is going on for conducting a business of a foreign entity, it is called permanent establishment. Whereas where strategic decisions are taken, it is called place of effective management. There are additional clarifications given regarding P, that is permanent establishment, which can be, you can say, about anti-fragmentation rules. Now, what is anti-fragmentation rules? Anti-fragmentation rule means that dividing your businesses in a small parts in order to book income in that small parts to take a advantage of corporate tax. This, to avoid this, they have framed anti-fragmentation rules. If a non-resident person is having only a permanent establishment, then income attributable to that permanent establishment of a non-resident will be taxable in UAE. So if place of effective management, then global income. But if only permanent establishment, then income attributable to that permanent establishment would be taxable. This is a very important concept because we have to, all the businesses need to analyze whether their place of effective management lies here or in any other foreign jurisdiction. This analysis will be helpful in taking your taxable decisions because tax can impact your major decisions. Next slide, please. Free zones. So this is a very much awaited decision on free zone qualifying income. Yes, we are waiting for the decision of what would be a qualifying income according to free zone, because qualifying income of free zone would be subject to 0% corporate tax and non-qualifying income would be taxable at 9%. One more thing which I need to add in a person, free zone person having qualifying income and a non-qualifying income. For a non-qualifying income, the threshold which we discussed in the first or second slide when we started of 375,000 dirhams is not applicable to them. So on a non-qualifying income, the threshold limit is not applicable. The branches of a mainland company is also the branches of a mainland company in free zones would be considered a free zone. Foreign persons have option to transfer their place of incorporation to free zones. So one more clarity which they gave was that, for an example, your place of effective management of a free zone is place of effective management of a company is in free zone. Then it would be considered as a mainland resident company, means because free zone company is having a qualifying income is not taxable. That's why in this thing, the place of effective management, even though it is free zone, it would be considered as a mainland company. This is a very important point which free zone companies and foreign companies need to note. So basically, yes, we await the decisions of what would be qualifying income. But yes, free zones are given benefits that qualifying income would be subject to 0% corporate tax. Next slide, please. As we discussed, exempt persons, government entity, government controlled entity, this person engaged in extractive business. Now, why person engaged in extractive business and non-extractive natural resources business are exempt person? They are considered in the exempt person list because they are taxed at emirate local level taxation. One more thing which we need to take care is that person engaged in extractive business and non-extractive natural resources business, if doing any other business activity apart from this, needs to register for a corporate tax and they have to pay corporate tax on that business income. Qualifying public benefit entity. What is qualifying public benefit entity? Any public benefit entity which works for charity or in general for the benefit of public is called a qualifying public benefit entity. Here the clarification in explanatory guide is that qualifying public benefit entity doing business, earning profits for doing charitable activities, means they are earning profit but using that money in charitable activities are also exempt. So even if they do business activity but they use that profit for charitable activities, they are exempt. This is the main clarification in an explanatory guide. Qualifying investment fund, as it is already discussed in Article 10, and public and private pension fund, this all are already discussed. These were the main points in explanatory guide which needed to be noted about qualifying public benefit entity as well as extractive and non-extractive natural resource business. Now, when we talk about government controlled entity, is different, a separate juridical person from the government organization. This is main clarification. Another clarification is, if a government entity is outsourcing any work to a juridical person for any work, that juridical person would not be considered an exempt person because government is outsourcing it to a juridical person. Next slide, please. Transfer pricing, as Arslan sir has discussed it in very good manner, I would like to just highlight few things that transfer pricing says that any any transaction done with related party or connected person should be at arm's length. Now, there are methods for arm's length. The arm's length methods, what benefit here we have in UAE is that you can follow any method or combination of any method. That is a very good and a welcoming move. Another thing about limits of 200 million, but still TP disclosure form, because if you are doing a transaction with related party or connected persons, there should be some benchmarking on that. How did you decide this rate? For that, this TP disclosure is very important. For an example, if I say payment to connected persons in a company, you are paying salary to the owner. Now this becomes connected person. Now what salary you are paying, on what basis you are paying, this should be at market value. If it is above market value, that difference amount would be added back into your computation of taxable income. Next slide, please. Tax group. As you already know, in VAT also tax group can be formed. So here in corporate tax also they are allowed to form a tax group. Now there are some conditions for forming a tax group. One condition is ownership. That is at least 95% of the ownership and voting rights of the subsidiary should be with the parent company. This is the main thing. What will happen if you form a tax group? There was one clarification regarding revenue. Transactions between a tax group should not be considered in the revenue. So when you are calculating the revenue, you have to eliminate the transactions of a tax group to come to the figure that what your revenue is in that particular financial year. There are some exclusions as well. For an example, qualifying you have one free zone company which is taking the benefit of qualifying income. Then it cannot be a part of the tax group because it would be difficult to calculate taxation on that purpose. Now, one more thing that we need to take care is for forming a tax group, the financial year should be the same financial year and the accounting standards followed should be also be the same. Next slide, please. So here it's about foreign tax credit. It is a very important point. Practically, for an example, I would go by example to make it easier for you to understand. Let's take an example that you have a corporate tax liability in UAE. For an example, 100,000. You have paid corporate tax in other jurisdictions, but you are taxable here in UAE. The foreign tax that you have paid in other jurisdiction, that income is added in your UAE jurisdiction, so you can take a foreign tax credit of the same. But it should be not be more than the domestic tax liability. And if there is some unused credit of foreign tax, it cannot be carried forward. This is a very important point. But one more important point that you need to keep in mind is whatever foreign tax you are paying, you need to have a proper documentation to prove the same to the authorities over here. Next slide, please. As we all talk about general anti-abuse rules, I would like to explain it as simple as possible. The main purpose of this is that no such transaction should be done which is done by keeping in mind of taking a corporate tax advantage. This is the main thing of GAR, that is GAAR, General Anti-Abuse Rules. This any transaction which you are entering, and the transaction which you are entering is because you want to take a corporate tax benefit. So it is a very wide rule, and every business needs to take care about this rule, because this is applicable. This is already applicable, it is in place. And so whenever you are making an opening balance sheet, you need to keep in mind these rules, and then your opening balance sheet should be prepared, because this can impact your tax liability as well. Next slide, please. I would request Yedu, my colleague, to kindly go through the slides about filing, payment, and refund, please.
Hi, thank you, Sohail. Thank you for detailed analysis of explanatory guide issued by the ministry. Hope I'm audible. So, as you know, in order to comply with the corporate tax in UAE, the first and foremost thing is registration. So, as and when ministry issued decree law, we got many questions from the businesses. What is the deadline to get registered with Federal Tax Authority? So, as of now, we don't have any particular deadline to get the registration with Federal Tax Authority. However, we have a special uh, registration deadlines for exempt person, as mentioned by Mr. Ashlan. So, if you look at other regions, we have like the advanced tax payments. So, whereas in UAE city, we don't have any such kind of provision to make advanced CT payment to the Federal Tax Authority. So, if you look at the deadline for filing of CT return, the deadline will be within 9 months from the end of the relevant tax period. Let's say the company chose the tax period of January to December, the first CT return will be due on or before 30th September of next year. So hope this is clear. I'm just hand over to Mr. Aslam to give closing notes. Thank you.
Thank you, Edu. So, guys, like we just explained, that there is a lot of information which we already know. And also, there is still some of the key information which is yet to come. For example, who is going to be the qualifying free zone person? Then what's going to be the definition of qualifying income? Then what rules we're going to apply on the financial statements for transitional rules? Then pillar 2. So there are some key things which are yet to be issued, and I'm expecting these to be issued ASAP by the ministry, so that people can actually take that into account in their corporate tax journey. So I think for businesses, what really they need to do, where do they go from here? So what is important for businesses to do is, look, all of these cabinet decisions which are being issued. So now you need to go back, and then you need to assess, understand what has been, what information has been given in the decision, and how does it impact on your already mapped roadmap. And then you need to go back and then take that into account. CT registration, like Yedu said, it's already open for most businesses. So although FTA is requiring everybody to register the entity separately, and then you can worry about making a tax group at a later date. However, the only advice would be, even if, for example, you need to do some restructuring, or you need to have an assessment done to make sure whether all the entities you currently have, whether all of them needs to be registered, or by the time corporate tax is applicable on you, then that entity is not going to be there anymore. Then you need to continue doing your impact assessment. There are a lot of clients who are very proactive and they already far ahead actually on the corporate tax implementation journey. The assessments and the implementation is very far advanced. However, at the same time, there are a lot of people who have actually done nothing so far. So people need to think about their accounting policies. They need to think about different structure. They need to think about their readiness. So all of these things they need to think about. Transfer pricing as a whole, it's very, very important and people are not used to it. So people need to be ready to be able to embrace transfer pricing rules, to be able to figure out what the arm's length prices are, if they have to get into agreements, if these are already not sort of formalized, then all of this they need to do. Then you also have FTA clarifications. So all of these clarifications are coming right now. But for example, if you have a particular transaction or particular thing where you want to go and seek a private clarification, then you need to decide whether what it is and when you actually go to them and then get the clarification sorted out. Then you have the system readiness. So you need to have your transfer pricing, your policies in place. You need to have your team in place. Because right now, generally, what I have seen, people are operating on a very lean environment. Some of the even large groups, they don't necessarily have internal tax people. Then your senior management is also very occupied, and then but they need to be involved in all the key decisions which are going to happen. So my advice to you all is just do a couple of things. Take stock where you are right now and what needs to happen from there onward before you go live on the tax. Then substance over form, that's also very, very important. So you just need to make sure that whatever is happening is not just like happening in paper. Then you also need to understand the substance as well. You need to have the awareness of the law, all these decisions and everything which is keep on coming. The information flow is huge. So you need to stay on top of it. You need to make sure you understand and you apply. And then you also need to then make sure whoever is involved internally, then you need to provide them with the support. Either those are the external pair of hands you're going to lend to them, or you're going to get them training or whatever the case may be. So all of these things needs to happen very soon. So that you guys are going to be ready before the go live dates for your entity or business. So I think that's all from our side. So now I think we're going to be opening up for the questions. We already had so many questions which are already come on. I don't think we will be able to answer all of them. We're going to try to answer as many as possible. Please make a note of the email ID which has been given here. Please feel free to ask us any questions, and then we will try our best to answer them. And also for the slides and stuff, that will be shared with all the participants, so you don't need to worry about that. So I think let's start from the time. So I think the question is for you, Suhail. So somebody is asking, which free zones are qualifying free zones?
Yes, Arslan, thank you. As I said in my presentation as well, we are awaiting a decision about qualifying incomes. So once we get the decision about what would fall in the definition of qualifying income, we would get clarity that what would be which free zone is a qualifying free zone, or you can say that which income would be qualifying as a 0% corporate tax rate and which income would be at 9% corporate tax rate.
Okay, and then another question, somebody is asking what comes under personal income. So I think I already explained, for example, your salary income, that's not going to be treated as under the corporate tax. Your real estate investment income or any other investment income you have, so that's not going to be under the remit of corporate tax. And that somebody's asking, I think that's for you, Suhail, that can you please briefly explain what is the difference between a freelancer and a natural person?
What is the difference between a freelancer and a
natural person from a tax perspective?
Yeah. So basically, what we understand, what I understand basically is freelancer is working as an individual person. He becomes a natural person in himself. So what would be the basic difference? The basic difference would be nothing. Freelancer is a person working, but what you need to take care regarding this is that if a freelancer is doing a business, he would have a limit of 1 million turnover. But after that, he can have that benefit of 3 million turnover as well. But after 1 million turnover, he is eligible. He needs to take a corporate tax registration.
Okay, thank you. So then somebody is asking 3.15 billion is for the multinational groups or for the corporate entities?
Yeah, but entities in UAE, but part of a multinational group.
Okay. Yeah, so those will be the entities who will be coming under the Pillar 2, and they will be subject to the 15% tax rate. And then next question is saying, does the threshold calculated by the revenue of UAE company for transfer pricing?
I didn't get the question.
So I think somebody is basically trying to figure out what is the threshold for people to apply the transfer pricing rules.
Yeah. So basically, as per the cabinet decision, revenue is 200 million for transfer pricing rules. But again, as we discussed, as we said, that is for preparation of local file and master file. If you are doing a transaction with a related party, then it has to be done at arm's length price, that is benchmarking and at the market price. So a disclosure form and clarification and explanation of disclosure form is very necessary.
Okay, and then somebody's asking, when does LLC needs to register for CT if it started commencing business from June 2022?
So registrations for LLC, I think this question Yedu can answer.
Yeah, let me take this question. So as I mentioned, there is no specific time limit to get registered with Federal Tax Authority. However, we are suggesting our clients, you need to get registered before filing first CT return, which is due based on their tax period. So this is a very simple process. This is like 5 steps process where FT will be requiring the trade license and details of our signatory and proof for our signatory. That's it. This is a very simple process. So as I mentioned, there is no specific time limit to get registration with Federal Tax Authority.
Okay, then next question is for you, Suhail. Saying, does the LLC needs to register for CT if the annual revenue is less than 1 million?
See, the cabinet decision which came, that was for natural person. So we can assume that they need to register for CT, and basically they can get a limit, a rule of 3 million, and they need to file the nil return.
And they're saying, are there any set rules for cash-based accounting?
Yeah, cash-based accounting, basically, there was a recent decision maybe 2 days ago regarding cash basis of accounting, but cash basis of accounting is allowed till 3 million turnover. Then you have to follow the normal accounting rule as per IFRS for SME.
Okay, so we still have so many questions, but I'm just looking at the time. So I think I'm just going to take a couple more questions, and then guys, if we haven't been able to answer your question, then please feel free to email us, and then we'll try our best to get back to you. So one question is rent of a villa in the name of owner is deductible use for business?
Rent of villa in the name of the owner.
Yeah.
But it is used for business purposes.
Yeah.
Well, it will be, but covered under as you can say connected persons. So the transaction should be at market price, and if you have to properly prove it that it is a business expense. If you are able to prove it business expense and it is at market rate, then it is allowable. But it is debatable. It bases on facts.
Okay, so I think that's probably going to be last question. And saying, is it necessary to have double tax treaty with the foreign entity? Although I'm not sure the question is complete, but I think the double tax treaty rules are in relation to the foreign tax credits. So I think you will have the tax credits and you will be able to utilize those here while doing your tax return. I think that's all I think we had the time for. I would like to thank every single one of you for your participation, for attending. We will share the details with you guys or as per the registration. And then stay tuned for more webinars, which are going to be coming as and when we are getting more information from FTA and all the ministries. And thank you so much once again, and then take care.